Ladies and gentlemen, welcome to Asian Guy Analysis on 19th of January 2026. What's happening? Precious metals family, if you're watching this right now, you're witnessing an important moment in the markets. Gold has moved above $4,689 per ounce. Silver has crossed $94. These are record levels, and for anyone holding physical metal, today has clearly been a strong session. But this move is not random. It did not happen without reason. There are specific developments in the global market that led us here, and understanding them helps explain why precious metals are reacting the way they are. So let's go through it step by step. First, let's talk about the numbers. Gold rose about 1.6% in early trading. It moved from the mid 4,500 range to a peak near $4,689 within hours. Silver followed closely, pushing into the mid 90s. For anyone who has followed precious metals for years, you know that moves of this size usually come after a clear catalyst. And this time, that catalyst was geopolitical news. Over the weekend, the U.S. administration said it is considering additional tariffs on European countries. This discussion is linked to political and strategic issues involving Greenland. Markets reacted quickly. U.S. stock futures moved lower, the U.S. dollar weakened. European leaders indicated they are preparing responses. When major economic partners show signs of disagreement, markets tend to adjust fast. In these situations, investors often reduce exposure to assets that depend heavily on stability and growth. At the same time, they increase exposure to assets that are widely viewed as stores of value. That is where gold and silver come in. Gold has long been treated as a global reserve asset. It is held by central banks, institutions, and governments across the world. It does not rely on the strength of a single currency. It trades globally and has deep liquidity. Silver also benefits during periods of uncertainty, but it behaves differently. Gold is mainly seen as a monetary asset. Silver has both monetary and industrial roles. This difference matters. Recently, large financial institutions have said they currently prefer gold over silver. Their reasoning is based on market structure rather than short-term price moves. Gold markets are deeper. Large positions can be entered or exited with less disruption. Silver markets are smaller and tend to move faster in both directions. That means stronger rallies, but also sharper pullbacks. Silver also has significant industrial demand. It is used in electronics, energy-related technologies, and manufacturing. Because of this, silver prices can be influenced not only by market uncertainty, but also by changes in economic activity. This does not make silver unattractive. It simply means silver behaves differently than gold. Historically, when precious metals move higher, silver often outperforms gold on a percentage basis. At the same time, silver usually experiences more volatility. Another metric investors watch is the gold to silver ratio. Right now, that ratio remains higher than many long-term historical averages. Some investors view this as one of several indicators when comparing relative value between the two metals. It is also important to look beyond today's headline and understand the broader backdrop. Inflation has remained a topic in global markets for several years. Prices across many economies have adjusted upward over time, affecting everything from energy and food to housing and services. At the same time, government debt levels are high across many countries. Public borrowing has increased as governments respond to economic slowdowns, global events, and policy priorities. Central banks have taken active roles in managing financial conditions. This includes interest rate decisions, balance sheet policies, and market guidance aimed at maintaining stability. Together, these factors shape long-term investor behavior. When investors look beyond short-term price moves, they often focus on how economic systems function over extended periods. This includes how currencies behave, how purchasing power changes, and how different asset classes respond to policy shifts. Over long periods, fiat currencies tend to lose purchasing power. This is not unique to any single country or currency. It is a structural feature of modern monetary systems. Because of this, some investors choose to include hard assets as part of broader portfolio strategies. This approach is not about predicting immediate market moves. It is about diversification and balance. Gold and silver have historically played that role for many people. They are tangible assets with global markets and long trading histories. Gold, in particular, has often been used as a reserve asset by institutions and governments. Silver has served both monetary and industrial purposes. These characteristics are part of why precious metals continue to attract attention during periods of uncertainty. Another factor at play is momentum. When gold reaches new highs, it naturally draws more attention for market participants. Media coverage increases. More analysts comment on the move. Trading activity rises. As more participants notice the price action, trading volume often increases. This can amplify short-term movements. It is important to note that momentum does not guarantee future price direction. Markets can move higher, pause, or reverse. However, momentum does influence short-term market behavior by shaping expectations and positioning. Silver often reacts after gold. Sometimes this reaction comes with a delay. Sometimes it happens quickly. In many historical cases, silver has moved more aggressively than gold once momentum builds. At the same time, silver has also experienced sharper pullbacks. This is why understanding volatility is important. At the same time, it is essential to talk about risk. Markets do not move in straight lines. Price trends can change quickly based on new information. If trade discussions ease or negotiations progress, some investors may take profits after sharp moves. This behavior is common across financial markets. Profit-taking does not necessarily signal a long-term change in direction. It often reflects short-term positioning. Interest rate policy also plays a role in precious metals pricing. Higher interest rates can reduce demand for non-yield assets, as returns on cash and bonds become more competitive. On the other hand, stable or lower rates can be more supportive for metals prices. Expectations around future policy decisions often matter as much as current rates. Silver carries additional sensitivity due to its industrial role. A significant portion of silver demand comes from manufacturing, electronics, and energy-related uses. If economic activity slows, industrial demand can soften. That can influence silver prices alongside monetary factors. Because of these combined influences, outcomes are never guaranteed. This is why many experienced market participants avoid making decisions based purely on short-term price action. For people following precious metals, emotional responses to rapid price changes can increase risk. Strong moves can create excitement. Pullbacks can create frustration. Long-term perspectives help reduce the impact of short-term noise. Many long-term holders focus on gradual accumulation over time rather than trying to time exact market levels. This approach spreads exposure across different price points. Others periodically review their allocations. This helps ensure that price movements have not shifted portfolio balance more than intended. For example, a strong rally in metals could increase the percentage within a portfolio. Some investors respond by rebalancing. Some investors separate long-term holdings from shorter-term exposure. They may use different instruments for different goals. Long-term holdings may focus on stability and preservation. Shorter-term exposure may focus on market participation. These decisions depend on individual objectives and risk tolerance. What matters most is clarity. Understanding time horizon is important. Understanding comfort with price swings is important. Understanding why an asset is held is important. Looking ahead, there are several factors worth watching. Developments in trade discussions between the US and Europe remain relevant. Policy signals and official statements can influence market expectations. Movements in the US dollar also matter. There has historically been an inverse relationship between the dollar and precious metals, although this relationship can vary. Broader stock market trends provide context as well. Periods of market stress often coincide with increased interest in defensive assets. Signals from central banks regarding interest rates and liquidity continue to be closely monitored. Guidance around future policy direction can influence investor positioning. Gold reaching new highs is a notable technical event. It reflects strong demand and market interest. Silver approaching major historical levels is also significant. Such levels often attract attention from both traders and long-term participants. Whether prices continue higher or pause, the drivers behind these moves remain connected to global policy decisions, economic conditions, and investor behavior. Markets evolve as new information becomes available. Expectations adjust. Positioning changes. This is not about predicting exact prices or timing markets perfectly. That is rarely achievable. It is about understanding why markets move, recognizing the factors involved, and staying informed. Precious metals have played a role in financial systems for a very long time. They have existed through different economic models, currencies, and policy regimes. That historical context is part of why they continue to be discussed today. As always, taking time to do your own research is important. Understanding personal objectives helps guide decisions. Aligning actions with individual circumstances reduces unnecessary risk. Thanks for watching, and stay informed.